Furman Insurance and Benefits is happy to bring you this educational video on inflation, certificates of deposit, and potential solutions to combat inflation. Somebody once said that subtle and gradual steps of erosion always lead to severe consequences. This is true. Erosion can also lead to very grand consequences over time. Now, let's talk about a consequence that is not quite as beautiful as the Grand Canyon, and that is inflation. A simplified definition of inflation can be the general increase in prices of goods and services that erodes the purchasing power of one's money over time. You see, inflation is very subtle and very gradual, but can have severe consequences on a retirement portfolio if that portfolio is not earning rates of return to offset that inflation rate. For instance, let's look at the rule of 72. Now, not the rule of 72 that you may be familiar with, but rather the inflation rule of 72. The inflation rule of 72 says that if you divide the inflation rate into 72, that will give you the number of years that it would take to cut the purchasing power of your money in half. Let's take a quick simplified example. If you had $100 under your mattress today, and if inflation was 3% going forward, it would take 24 years for the purchasing power of your $100 to be chopped in half. Now, you may be asking, but what is the inflation rate? Well, let's look at what inflation has done over the last 35 years because it really ebbs and flows. As you can see, over the last 35 years, inflation has been as high as a little more than 5% to as low as slightly negative in 2009. Of course, we do not yet know what 2020's inflation rate will ultimately be. Now, the more important question would be, have interest rates on savings products kept pace with inflation? In other words, if you had invested your money into a 5-year certificate of deposit, for instance, would you at least have kept pace with inflation? Now, here we compare the year-by-year levels of inflation to the national average 5-year certificate of deposit rates over the last 35 years. As you can see, the CD rates have dropped substantially over the last 35 years to where the national average today is only 0.69%. As you can see, during the first 25 years of this chart, the average 5-year certificate of deposit kept pace with inflation and then some. However, over the last 10-year period of time, it has been a different story as the black inflation line has very frequently been higher than our blue certificate of deposit line. Erosion of the purchasing power of one's money is what that means when the black line is higher than our blue line. Okay, so what is a possible alternative that may do a better job at keeping pace with inflation? Well, first, let's look at a simplified and hypothetical example of the stock market. As we know, the stock market can drop. Let's say that you had your money invested in the stock market and it lost 20% in 1 year. Then the following year, the stock market went up 25%. Now, some may not realize that when the market loses 20%, then comes back up 25%, that the stock market is merely back to where it started. Now, this, along with other reasons, has led many consumers to look to more safe alternatives than the stock market, but yet an alternative that gives them upside potential of earning more interest than certificates of deposit, like we previously discussed. Now, this is where we would like to introduce you to fixed indexed annuities. Fixed index annuities have significantly grown in popularity over the last 2 decades as consumers have experienced decreasing interest rates as well as, substantial stock market volatility. A fixed indexed annuity provides growth that is linked to a stock market index, such as the S&P 500, for example. But at the same time, should that market decrease, the consumer will not lose money as a result of that market decrease. A common fixed indexed annuity design that will be used in our hypothetical example is an S&P 500 indexed annuity that has a 5% cap. The cap being the most that the consumer can earn in a given year. Now, in our previous example, our hypothetical consumer would not have lost any money when the market dropped 20%. Then, in the next year, when the market recovered, the consumer was able to earn up to the 5% cap. Many fixed indexed annuities have no charges, just a cap. So in our example here, instead of riding the volatile stock market ride to get back to where the consumer started, our hypothetical consumer never lost a penny of their money and ended up 5% higher than where they started. What about inflation offsetting potential? Well, if we took the last 10 years of inflation that we discussed previously and overlaid what the rates would have been credited on our hypothetical fixed indexed annuity based off of what the S&P 500 index did, that is, you can see the respective growth rates of our fixed indexed annuity in blue year by year by year. Although indexed annuities are not designed to beat the stock market, they are a very good solution for consumers that are looking for an interest rate beyond traditional guaranteed products, while at the same time not having to ride the roller coaster ride of the stock market. Additionally, many fixed indexed annuities have features that provide you with guaranteed lifetime income that you cannot outlive. We hope you enjoyed this educational video on inflation, certificates of deposit, and fixed indexed annuities. Feel free to contact Furman Insurance and Benefits at 978-494-6611 or visit our website at www.furmaninsurance.com.